Hello, everyone. My name is April, joined by my teammates Vanita, Zahan, and Evander from the corporate strategy team. And today we will be recommending the Airbnb acquired TripAdvisor. We'll walk you through why this deal makes sense, the numbers, and the questions we'd want answered before closing.
Our corporate strategy team recommends that Airbnb pursue a friendly all-cash acquisition of TripAdvisor. Strategically, the deal strengthens Airbnb's experience platform by adding realtors, supply bases, local infrastructure, and trusted reviews, which should allow Airbnb to scale faster than building internally. Financially, our base case DCF supports a $15.93 per share, and we recommend opening at $13.03 with a different negotiation range of $14 to $22. The deal is funded with existing cash, remains assertive at about 5.5 to 5.6%, and only modestly increased debt to capital from 20.1 to 21.4%. The main conditions before moving higher in price are diligence, confirmation of margin, debt treatment, and supplier retention, integration feasibilities, governance, and shareholder dynamics.
The travel industry is changing. Consumers aren't just booking a place to sleep anymore, rather, they want the whole trip all in one place. Discover it with reviews and book it without jumping from one app to another. Airbnb has the brand name and the traffic, but its experiences business unit hasn't really scaled the way it's supposed to. Building that capability from scratch takes years, and acquiring TripAdvisor is the faster and cheaper way to get there. TripAdvisor doesn't just bring a website, it brings Viator. Viator is a global marketplace for tours and activities with supplier relationships in place, booking infrastructure already built, and millions of verified reviews trusted by customers. So plug those assets in Airbnb and you get reduced friction, increased trust, and improved conversion. The value here isn't just from cutting costs, rather, it's from building a better product that drives more revenue.
Starting with the strategic rationale, the travel industry is increasingly shifting toward experiences rather than just accommodations. Today's travelers expect an end to end platform where they can discover, evaluate, and book activities all in one place. This transaction supports diversification across services, customers, and revenue. Experiences expand Airbnb beyond lodging, engage customers earlier in the travel planning process, and reduce reliance on cyclical accommodation demand. From a timing perspective, TripAdvisor recently completed its merger with Liberty TripAdvisor Holdings, eliminating its dual class structure and controlling shareholders. This simplification materially lowers execution risk and creates a clear window for strategic buyers like Airbnb. Looking at the SWOT analysis for TripAdvisor, several factors reinforce why this acquisition makes strategic sense. TripAdvisor's core strength is trust. It has a globally recognized brand and large base of verified traveler reviews. However, it faces slower growth and relies heavily on advertising with limited control over the full customer journey. Integration with Airbnb creates an opportunity to monetize experiences more deeply within a closed ecosystem and improved conversion. However, the key risks include competition from Google and OTAs, supplier disintermediation, and exposure to travel cycles.
Here I will walk us through the valuation of TripAdvisor. We ran two approaches, a DCF and a comparable company analysis, and both point to the same conclusion. TripAdvisor is significantly undervalued at its current price of 10.3, and our range across all methods is $14 to $22 per share. And with the DCF base case implying 16.93, and even our most conservation scenario landing at 14.07, every methodology shows a meaningful upside. Our recommended negotiation range is $14 to $22, anchored to the DCF and the EV to EBITDA, which is the profit-based metrics. We are treating the EV to revenue output of 47 as an upper bound only, Since the revenue multiples are sensitive to margin assumptions we haven't yet confirmed in diligence. We also recommend entering negotiations at 13.03 per share, which is a 26.5% premium to market, but deliberately below our range as TripAdvisor guide Q1 revenue down 3 to 5% year-over-year, so we are pricing in the near-term execution risk upfront. Any move above 13.03 should be contingent on what diligence confirms. Here, I also want to address synergies. This is a revenue deal, not a cost-cutting one. The thesis is very simple, so we integrate TripAdvisor's review and Viator supplier network into Airbnb experience checkout, so verified reviews at the booking moment build trust and lift conversion. Partial impact in year 1, fuller run rate after adoption stabilize. Key diligence risks are review data portability and supplier retention, and the deal is already EPS accretive without any of this. Synergies are upside, not the thesis. As for the mechanics, our WACC is 8.3%, built from cap M, a 4.1% risk-free rate of the 10-year treasury, beta of 0.93, and a 7.5% market risk premium, which we think is warranted given the macro uncertainty and travel cyclicality. On the debt side, we use yield to maturity on TripAdvisor's maturing senior note at 5.6% pre-tax, and since that $345 million note matures in April 2026, we net it out of both debt and cash, shifting the capital structure to 59 to 41 and nudging the WACC slightly higher. Terminal growth at 2.5%, revenue fading from 7 to 3%, EBIT margin held flat at 6%, which is deliberately conservative. As for the model output, FCFF are stable in the 128 to 135 million range throughout the forecast. Terminal value comes to 2.4 billion, the dominant value driver as expected for a mature platform. Discounting at 8.3% gives us an enterprise value of 2.1 billion and an implied share price of 16.93, and that's a 64% above where the stock trades today. And to make sure we weren't over-relying on a single set of assumptions, we built two sensitivity tables. The left varies WACC and terminal growth rate. Every service above 10.3 range is $14 to $22, and the right table is more important. It varies the WACC and EBIT margin. Every one margin improvement adds around $2.5 to $3 per share, so a recovery toward TripAdvisor's historical 8 to 9% margin pushed the implied value to $21 to $24, and that margin recovery is the central question diligence needs to answer.
So in addition to income valuation, we also looked at 4 comparable public companies: Booking Holdings, Expedia, Trip.com, and Yelp. We excluded Trivago as it's essentially a distressed asset with near zero enterprise value and heavy customer concentration. So across this peer set, the median multiples are 3 times the revenue, 11.4 times EBITDA, and 14 times EBIT. TripAdvisor is currently trading well below the 3, which tells us that it's priced at a discount relative to its peers. We picked the median because it ignores the extremes. With only 4 comps, one outlier like Booking at 4.8 times EV over revenue can pull the mean far enough to overstate TripAdvisor's value. So the median keeps the anchor honest. Applying those median multiples to the financials give us a wide range from $8.32 per share on EBIT and up to $47.26 on revenue. Revenue multiples tend to overstate value for a company with compressed margins, so we weighted EBITDA most heavily at 50% and revenue and EBIT at 25% each. This then gets us to a concluded value of $21.62 per share. We also looked at 4 recent deals in the travel space. The multiples here are lower than the trading comps. Revenue multiples cluster between 1 and 3 times, and most were private with limited disclosures. The travel space is also just rebounding post-pandemic, so we didn't have a pool of past deals to compare to. One deal worth flagging though is Expedia's recent acquisition of Tickets, a small experiences platform from the Netherlands for about $100 million. Airbnb actually passed on that deal, which tells us that Airbnb isn't interested in small bets. Rather, TripAdvisor is the scaled version of that same bet.
The combination analysis shows that the transaction is financially workable under our proposed all-cash structure. at the base case opening bid of $13, 0.3 per share, which represents a 26.5% premium to TripAdvisor's $10.30 trading price. The implied equity purchase price is about $1.54 billion. Across the premium cases we tested, the transaction remained accretive, and in the base case, it increased pro forma EPS by about 5.5 to 5.6% from 2026 through 2028. Pro forma debt to capital rise only modestly from 20.1% for Airbnb on a standalone basis to 21.4% for the combined company. The takeaway is that the Airbnb can pursue this transaction in all cash without equity dilution while preserving balance sheet flexibilities. We propose a fairly negotiated acquisition rather than a hostile approach, beginning with confidential CEO to CEO outreach, an NDA, and confirmatory diligence. The offer would be structured as a 100% cash funded from Airbnb's existing balance sheet, which avoids equity dilution and keeps pro forma debt to capital broadly in line with Airbnb's standalone profile. Our pricing recommendation is designed to balance strategic value with pricing discipline. We would open at $13.03 per share, or a 26.5% premium to TripAdvisor's current price, which gives the Airbnb a credible starting point without paying a fund for upside that still depends on diligence and execution. If the diligence confirms the margin path, supplier retention, and integration case, we will be prepared to negotiate within $14 to $22 range, with $22 as a hard ceiling tied to the top end of our valuation support. From our perspective, this protects the shareholders' value by keeping the opening bid different while still preserving the option to secure strategically relevant assets if the Fed support. Our synergies case is revenue lead and product lead, not cost cutting. The key opportunity are surfacing with the supply inside Airbnb experience. Using TripAdvisor review as a trust signal at checkout, cross-promoting Airbnb stays to a TripAdvisor trip planning audience, bundling login and activity in one checkout flow, and using shared data to improve personalization and conversion. We also see a smaller B2B aside through Realtor partner relationships and Airbnb for work. These synergies are achievable within 12 months to 24 months, but they depend on supplier retention, review data portability, and clean integration execution.
Before any deal closes, it's important to know, is there a credible path to 6% EBIT margins? Right now, TripAdvisor is at 4.2% and our DFC is most sensitive to that assumption. Every 1 point improvement is worth anywhere between $2.50 to $3 per share. Second, the $345 million senior note that will mature in April 2026. Has that been paid or refinanced, or does Airbnb assume it at close? And third, Starboard just became an activist investor on February 17th. What's their price expectation? And are they a deal accelerant or a complication? Those answers will determine whether this deal is worth pursuing or not.
These final diligence questions focus on execution risk. First, we need to confirm whether Realtor's key supplier contracts are transferable in the change of control and assets churn risk among top suppliers. Second, we need to evaluate the feasibilities, timing, distortion of risk of the integrating with advisor review infrastructure into Airbnb's technology stack. Third, after the Liberty of TripAdvisor merger, we need to confirm that the board is fully independent and authorized to negotiate and sell, and that no remaining governance provision could complicate the deal. Our corporate strategy team highly recommend this deal, and thank you for your time and appreciation.